Hello guys, welcome to my channel. This is Eunice Financial Academy. In today's video, we are looking at ledger account or T account. So we have the ledgers and we have the ledger account. So let's look at the definition of a ledger. A ledger is a book or collection of accounts in which accounting transactions are recorded. So that is the definition of a ledger. So we also have examples of ledgers here, like the rent and the bank account. So these are how the presentation of a ledger. And also note that it has a debit side and a credit side. The debit side increases the expense and the asset account, and the credit side reduces the expense and the assets account and increases the liability, equity, and revenue account. So just like we saw in the journal, it is the same thing in the ledger account. And don't also forget that a ledger account is the second source document from the journal we are posting to the ledger account. So there are three types of ledgers. Three types of ledgers. So we have the general ledger. The general ledger, the sales ledger contains the T account of customers, and the purchase ledger, which contains the T account of suppliers. So we are going to look at this in details in our subsequent video. So for now, just look at the definitions. So let's look at the definition of a ledger account. A ledger account records all transactions affecting a particular account in the general ledger. It records all transactions affecting a particular account in the general ledger. So the ledger account has a format like this. So here we have the debit side. This is the debit side and this is the credit side. So on the debit side, we have the dates, particulars, ledger folio, and the amount. So on the credit side, we also have the dates, particulars, ledger folio, and the amount. So we have the debit side this way and the credit side. So this is the format of a ledger account. So there are different types of ledger accounts. So we have different types of ledger accounts. So these are the different types of ledger accounts. So we have the first one, which is the asset account. We have the expense account. So let me explain the asset account. So remember, the asset account and the expense account belong to one group. Why? Because the two have a debit balance. So the debit side increases the asset account, or the debit increases the asset account, and the credit reduces the asset account. So looking at the asset account, you will see a balance brought down. So this is the balance for the previous year, or the opening balance for the current year. And then we also have the balance carried down. So this is the closing balance for the current year, and it is going to be the opening balance for the next year. So this is an asset account. And please remember, when we say asset account or assets, we are talking of furniture, cash, bank, inventory or stock, or receivables. Those are assets. So don't go and open your account and then you write asset here. No, this one is a main heading. So the main asset is there, like the furniture, the cash, the receivables, and stocks. So those are assets. So for instance, if we bought an asset, say we bought furniture for $5,000, so it increases, the debit increases the asset account. So we bought furniture. So we are going to debit the furniture here and the amount here. So furniture is coming here because it is furniture, or the furniture account will be recorded here as furniture. And then the means of payment, maybe we bought it with cash. So we are going to record the cash here. So furniture here and the means of payment here, cash. For how much? 5,000. So we put our 5,000 here. So this is the opening balance here, and this is the closing balance. So we also have expenses. We also have expenses. Say we bought furniture, and then we had to pay for transportation. Transportation is an expense. Transportation is an expense. Rent is an expense. Salary is an expense. So you are going to write the name of the expense account here. For instance, rent, you are going to write it here, not expense account, please. You write rent here, or you are going to write electricity bill here. It is an expense account, or salary. So if you pay salary, say you paid salary for $60,000. So the salary, the name salary will fall here, salary account. And then you paid with cash. So you write cash here and you write 60,000 here. So it is increasing the debit side, or the debit side increases the salary or the expense account. So the expense account also have an opening balance and a closing balance. So this balance is the balance for the previous year that is brought forward as the opening balance for this current year. And the closing balance here is the closing balance for this current year. So in the next year, this balance is going to be an opening balance. So that is what you need to understand. So remember that the asset and the expense account has a debit balance. And also when doing your recordings, take note of the golden rule of accounting that says that debit all the expenses and losses, you credit the incomes and the gain. Debit the receiver, you credit the giver. Debit what comes in and credit what goes out. So those are some of the things that you need to keep at the back of your mind. And then also, there are some techniques that you need to apply when recording your account. The first one says you must identify the account, the different accounts in a transaction. The least account in a transaction is always two. So we have from two or more accounts. So identify the transaction or the account in the transaction. So for instance, if we paid rent for cash, so that is a transaction. So what are the two accounts in that transaction? We have rent. Rent is an expense and cash is an asset. So those are the two accounts in that transaction. So you must identify them to know where you are going to place them, whether it is an asset or a liability. So let's look at the other side. So we have the liability account, equity account or the capital account. Then we have revenue account. So all these three accounts fall in one group because they have credit balance. So when we talk of credit balance, it means that the credit increases the liability. Credit increases the liability, increases the equity or capital account, and also increases the revenue. So the liability, you see the balance brought forward is at the credit side because it has a credit balance. So this is the balance brought forward or the opening balance. Remember, it is the balance from the previous period that is being brought forward. And we also have the closing balance at the debit side. So if you are doing your account or you are posting here, this side, the credit side, needs to be greater than the debit side. So remember liability, we have liabilities like loan, we have liabilities like suppliers. So please don't go and put liability account, no. For instance, if you paid your supplier is a liability. So you are going to put the name supplier here, supplier account. So you open an account for your supplier. So that is the liability. So here we are just saying that all liabilities, if you come across a liability or an account that is a liability, you know that it is having a credit balance. And then we have the equity account too. This is the opening balance and this is the closing balance. So equity account or capital account, the credit side increases the equity account, meaning this side is greater than this side. Reason we say it has a credit balance. So same thing with the revenue account. So the revenue account has a credit balance. It means that we have to credit revenue. So you have the opening balances and we have the closing balances. So let's see how we can balance a ledger account. So I have taken one asset account and one liability account. So let's assume, for instance, we receive cash of let me say $10,000, and then we also make some sales for say $2,000, and then we pay rent. We pay rent say for $1,000, and we also paid electricity for $1,000. So if you look at this account or this ledger account, you will see that it is the debit side that is greater. So 10,000 plus 2,000, that is 12,000. We have $12,000 here. And then remember, this is an asset. Asset has debit balances, or the debit increases the asset. So here it is 2,000. So we have to close this account. So this is the balance carried down. So what is the difference? So if we have we put 10,000 here, so 12,000, sorry, this is 12,000. So the debit must be equal to the credit. And then this one now is the closing balance. This is the closing balance or the debit balance because the debit side is greater than the credit side. So here, capital, say we invested 50,000 into the business. So in the capital account, remember there are always two accounts. So we have invested cash, for instance. So in the capital account, let's assume the cash that we invested was 600, And then we also have some amount here, say 1,000. Then we also have some amount here, uh, 400. Then we have 100. So if the credit side, this is a credit balance because it is a liability. Capital has a credit balance because it is a liability. So we have 1,600 here, and then it should be 1,600 this way. So this one is 500. So the closing balance will be on the debit side. The closing balance, this is the balance carried down, will be on the debit side, which is 1,100. So looking at these two accounts, you see that in the asset account, the closing balance is at the credit side, and with the liability account, the closing balance is at the debit side. Please always take note, because this one has a credit balance and this one have a debit balance. So always take note of some of these small things when doing your ledger account or when posting. So please, thank you for watching and see you in the next video.